All right, let's dive straight into this explainer. We're looking at a massive, completely unexpected move from one of the most closely watched investment portfolios on the planet. I mean, Wall Street absolutely loves a good mystery, right? Well, in the second quarter of 2026, Berkshire Hathaway delivered a massive one. Basically out of nowhere, they made a multi-billion-dollar bet on Google's parent company, Alphabet. Now, you know Berkshire Hathaway isn't exactly famous for being a tech pioneer, aside from their giant Apple stake, obviously. So what on earth do they see in the search giant right now? Today, we're putting on our detective hats, we're going to piece together the clues of this huge capital deployment and figure out exactly what it means for the broader economy. To kick off our detective work, just take a look at this number, 83%. In a single quarter, Berkshire cranked up its Alphabet position by an astonishing 83%. That's adding roughly 48.1 million shares. Now look, when you're managing a portfolio the size of Berkshire's, a jump this big, that's not just some minor portfolio rebalancing. That is definitely not a rounding error. It's a blaring siren of major conviction. It essentially tells us that someone at headquarters saw a fleeting opportunity, a real mispricing in the market, and they just couldn't ignore it. This aggressive move pushed their total stake to an unbelievable 106 million shares. That was valued at about $37.8 billion at the end of June. Just let the sheer scale of that sink in for a second. That valuation instantly rocketed Alphabet into the absolute upper echelons of Berkshire's portfolio. It's now their third largest stock holding, sitting right there behind Apple and American Express. It fundamentally reshaped the whole architecture of their holdings. And you know, when Warren Buffett's team makes a move this heavily concentrated and this massive, the entire financial world stops and asks, okay, what do they know that we don't? And the crazy disparity between their buying and selling here really illustrates a broader shock to Wall Street. During the quarter, Berkshire bought roughly $23.5 billion of stocks, while they only sold about $3.7 billion. They didn't just quietly inch back into the market or, dip a toe in the water. No, they suddenly went on the attack. This wasn't just an isolated Google trade. This was a massive, sudden deployment of capital across the board, which really signals a dramatic, foundational shift in how they're viewing the market right now.
But what makes this deployment so dramatic and honestly so wildly out of character for their recent history is the number 14. This giant buying spree abruptly ended a streak of 14 consecutive quarters where Berkshire was actually a net seller of stocks. I mean, for 3.5 years, we'd all grown so used to watching Berkshire just hoard enormous piles of cash, quietly trimming their equity exposure, just waiting patiently on the sidelines. To suddenly flip the switch from that extreme caution to aggressive buying, that is a massive macroeconomic signal, and honestly, it's potentially way more important than any individual stock purchase on its own.
Section 1. The Alphabet Thesis. Why Google? So, the big question is why? Why did Berkshire choose to deploy so much capital into a tech company like Alphabet right now? Well, Alphabet isn't just a search engine, right? It's a sprawling, deeply interconnected ecosystem. Berkshire historically loves businesses with durable competitive advantages and fiercely protected cash flows. And Alphabet, it absolutely checks those boxes. You've got YouTube, which is just this global entertainment behemoth. You've got Google Cloud, bringing in massive, sticky, recurring revenue from huge enterprise clients. Toss in the Android operating system, their massive data centers, and literally billions of daily active users, and you're looking at an undeniable economic fortress. But it's definitely not all smooth sailing. As the saying goes, Google is trying to defend its search dominance while simultaneously building the next generation of AI products. They are fighting a high-stakes two-front war, caught in a super delicate balancing act. On one hand, they have to fiercely defend their traditional search business, which is literally the ultimate cash cow of the internet era. But on the other hand, they're making this aggressive, incredibly expensive pivot into artificial intelligence to fight off ruthless rivals like Microsoft and OpenAI. It creates a ton of systemic risk, sure, but it also creates a generational opportunity. Which brings us to our next section, the clash of ideas, bull versus bear. This is a classic clash of risks versus rewards in the AI era. The bull case is pretty clear-cut. You have Alphabet's massive cash flow, booming cloud computing growth, and its incredible long-term ownership appeal. It's an ecosystem built to practically print money. But wow, the bear case is heavy too. You have the unbelievably expensive reality of AI capital expenditures, CapEx. Building the brains of AI means buying hundreds of thousands of highly specialized chips and building sprawling data centers, literally burning through tens of billions of dollars before you see a single cent in return. Combine that with fierce competition from tech titans like Meta and Amazon, plus intense government regulatory scrutiny around their search and ad practices, and those risks really start to pile up.
And that brings us to the absolute most existential risk in this whole explainer. Could AI eventually weaken traditional search? Think about your own daily habits for a second. For years, we type questions into a search bar, click through 10 blue links, and inevitably view a bunch of ads along the way. But now, users are increasingly turning to AI systems for direct, immediate, conversational answers. If that consumer behavior shifts completely, and the world just stops clicking those blue links, Google's core digital advertising model, the very engine that funds their entire operation, could face some serious foundational pressure.
Yet, despite those massive structural risks, Berkshire's $37.8 billion position tells us they are entirely willing to stomach that uncertainty. Their foundational thesis seems to boil down to this: bet on the dominator, not the disrupted. Alphabet isn't just sitting around waiting for the paradigm to shift. Because they already control massive amounts of data, boast billions of deeply entrenched users, and own proprietary infrastructure across the entire AI stack, Berkshire is betting that Alphabet has the sheer financial firepower to dominate the next generation of the internet rather than get swallowed up by it.
Let's move to our final section, a new Berkshire era, zooming out.
When you actually zoom out, it reveals that Alphabet is only part of a much larger philosophical shift at Berkshire. Look at these moves. They increased their stake in Delta Airlines by 44%. They bumped up Lennar by 30%. They established a brand new position in D.R. Horton and completed a staggering $6.8 billion acquisition of Taylor Morrison. This totally proves we aren't just looking at a single isolated AI tech trade here. Berkshire aggressively deployed capital across airlines, housing, home building, and commercial real estate. This is a massive, highly diversified, and wildly confident bet on the long-term resilience of the broader American economy. With Greg Abel now fully at the helm as CEO, guiding the conglomerate's day-to-day capital allocation, investors are watching all these clues incredibly closely. While Warren Buffett has actually said he deserves credit for initiating the Alphabet position years ago, the massive scale and speed of these recent moves across multiple distinct sectors really provide a clear blueprint for the post-Buffett era. It's signaling loud and clear that this new leadership team isn't just going to sit on their hands and collect interest. We are officially entering a new, highly dynamic era of active, aggressive capital deployment at Berkshire Hathaway. But even as they shift from 14 quarters of extreme caution to this brand new wave of aggressive buying, it is so vital to recognize that the post-Buffett Berkshire is absolutely still following its foundational philosophy. They're still actively hunting for high-quality businesses with wide economic moats. They're still thinking long-term, deliberately avoiding excessive leverage, and maintaining enormous financial strength to weather any potential storms. So the traditional value investing playbook hasn't been thrown out at all. The market has simply shifted, and they're finally seeing attractive enough prices to execute the plays they've literally been waiting years to make. So what's the ultimate takeaway from all of this? Berkshire Hathaway is giving us one of the clearest, most profound early signals yet about how they intend to navigate the future of technology and the broader economy. They fundamentally believe that Google has the cash reserves and the institutional moat to not just survive but actively win the AI revolution. But as we look 5 or 10 years into the future and watch how direct answer artificial intelligence reshapes the very architecture of the internet, we have to ask ourselves, did Berkshire just make a brilliant $17 billion AI-era bet, or is the biggest risk still ahead? Keep a close eye on this one, because the outcome won't just impact a single portfolio. It's undoubtedly going to define the next decade of tech and investing.